Most people believe Warren Buffett became one of the world's most successful investors because he has an extraordinary ability to pick winning stocks. They imagine complex models, constant analysis, and perfect timing. But Buffett himself has said, repeatedly, that stock picking is the least important part of what he does. That idea alone makes many investors uncomfortable, because it challenges what they've been taught to focus on. Buffett's true advantage has little to do with intelligence or access to information. It comes from how he thinks when others panic, how he waits while others feel pressured to act, and how he behaves when the market tests patience over long periods of time. His philosophy is not built for excitement or speed. It is built for durability. Understanding this mindset changes how you see investing entirely. And once you see it clearly, the decisions that once felt difficult begin to feel surprisingly simple. Warren Buffett has often said that investing is not an intellectual contest where the smartest person wins. In fact, he once explained that you don't need a high IQ to succeed in investing. What you need is the ability to control your emotions when others can't. This is where most investors misunderstand his approach. They spend years trying to become smarter, faster, or more informed, while Buffett focuses on staying calm and rational. Markets regularly test temperament. Prices rise quickly, fear spreads, and logic disappears. In those moments, intelligence alone offers little protection. Emotional discipline does. Buffett avoids decisions driven by excitement, anxiety, or the need to act. He is willing to look wrong, to wait, and to do nothing when nothing makes sense. This consistent rationality, applied year after year, compounds quietly. And once you remove the need to be brilliant, a more important question appears. If intelligence isn't the edge, then what actually is? Warren Buffett does not believe successful investing comes from knowing a little about everything. Instead, he built his philosophy around a simple boundary he calls the circle of competence. This circle defines the businesses he truly understands, and just as importantly, everything he chooses to ignore. Buffett has said the size of the circle matters far less than knowing exactly where its edges are. Most investors feel pressure to constantly expand their knowledge, chase new industries, or follow trends they don't fully grasp. Buffett does the opposite. He protects his capital by saying no far more often than he says yes. Each refusal is not a missed opportunity, but a deliberate risk avoided. By limiting his focus, he reduces uncertainty and emotional stress. Clarity replaces complexity. But understanding a business is only the first step. Even within your circle of competence, the real challenge begins when you try to decide what something is truly worth. One of Warren Buffett's most quoted ideas is also one of the most misunderstood. Price is what you pay. Value is what you get. For Buffett, a stock is not on a screen or a short-term trade. It represents ownership in a real business with products, customers, and long-term earning power. The market price may change every day, but the underlying business usually does not. Buffett approaches value in a practical way. He doesn't rely on complex formulas or precise forecasts. Instead, he asks simple questions. Does this business generate cash reliably? Is it likely to remain relevant years from now? And does the current price offer a reasonable margin for error? This mindset turns investing into judgment, not mathematics. However, a low price alone does not create value. Even a bargain can become a mistake if the business itself lacks strength. And this is where Buffett draws another clear line. Warren Buffett understands that, the future is always uncertain, which is exactly why he doesn't rely on precise predictions. Instead, he reduces risk by owning businesses that can perform well, even when things don't go exactly as planned. A high-quality business has durable advantages that protect it over time, whether that's through strong brands, loyal customers, or cost structures that, honestly, competitors struggle to match. These businesses do not need perfect conditions to succeed. Buffett has often explained that it is better to buy a wonderful company at a fair price than a fair company at a wonderful price. Cheap businesses with fragile economics leave little room for error. Strong businesses forgive mistakes. Quality really does simplify decision-making. You don't need to forecast every detail when the business itself is resilient. But this advantage only works if you allow time to do its job. Owning great businesses is not about quick validation. It requires something most investors underestimate: the willingness to hold through uncertainty and wait. Warren Buffett has often said that time is the friend of a wonderful business and the enemy of a mediocre one. Yet many investors treat time as a problem to solve rather than an advantage to embrace. They look for results quickly, expecting compounding to show up in dramatic bursts. Buffett understands that compounding is not an event. It is a quiet process that works slowly and then all at once. Most of the gains in long-term investing come from simply staying invested, while others lose patience. Impatience leads to unnecessary selling, constant switching, and emotional decisions that interrupt compounding before it has a chance to accelerate. Buffett's wealth is often attributed to skill, but honestly, much of it comes from endurance. Holding for decades sounds simple, but it is psychologically demanding. And to do it successfully, Buffett has learned to ignore something that constantly distracts and destabilizes most investors, the market itself. Warren Buffett does not look to the market for guidance or validation. He views it as a tool, not a teacher. In his famous Mr. Market analogy, the market is an emotional partner who offers to buy or sell at wildly different prices each day. Those prices reflect mood, not reality. Buffett's advantage comes from recognizing that these swings contain no instructions, only options. When prices rise sharply, he doesn't feel smarter. When they fall, he doesn't feel fearful. He understands that emotional volatility creates opportunity, not information. The market's job is to quote prices. His job is to decide whether those prices make sense based on the business itself. This perspective removes much of the stress that causes investors to act impulsively. Ignoring daily noise becomes easier when decisions are grounded in fundamentals rather than headlines. And that discipline is reinforced when you have deep confidence in the businesses you own, not just the prices attached to them. Warren Buffett has long emphasized that the quality of a business is inseparable from the quality of the people running it. He really does not place much weight on detailed forecasts or long-term projections because, honestly, the future is just too uncertain. Instead, he looks for managers with 3 traits: integrity, competence, and the ability to allocate capital rationally. Integrity comes first. Buffett has said that without it, the other qualities can actually become dangerous. Honest managers make decisions that protect long-term value, even when short-term incentives tempt them otherwise. Competence ensures the business is run efficiently. Rational capital allocation determines whether profits are reinvested, returned, or conserved wisely. Buffett believes straightforward, trustworthy managers consistently outperform clever ones who chase complexity. Predicting the future is fragile. Good stewardship is durable. But even with excellent management in place, Buffett remains cautious. He avoids a behavior that undermines many otherwise sound investments, quietly eroding results over time. Warren Buffett's track record really challenges the idea that successful investing requires constant action. He's often pointed out that, activity and progress are just not the same thing. While many investors feel productive when they trade frequently, Buffett succeeds by doing less and thinking more. His portfolio turnover is low, and his best results come from a small number of well-understood, long-held positions. Every decision carries friction. Taxes, fees, and mistakes all increase with unnecessary movement. Overactivity creates the illusion of control, but honestly, it often leads to reacting rather than reasoning. Buffett avoids this trap by waiting for situations where the odds are clearly in his favor, then acting decisively. This approach requires patience and conviction. It also requires comfort with inactivity, which, let's face it, most investors struggle with. By resisting the urge to constantly adjust, Buffett protects long-term results. And this discipline connects directly to one of his most misunderstood principles about how investing success should be measured. Warren Buffett is not competing on the same scoreboard as most investors. He is not trying to outperform the market this quarter or even this year. His mindset assumes an effectively infinite time horizon, where the only meaningful measure is long-term business performance. This perspective changes every decision he makes. Short-term comparisons are misleading because markets are noisy and unpredictable over brief periods. Even sound investments can look foolish for years before their value becomes obvious. Buffett accepts this volatility as the cost of long-term ownership, not as evidence of failure. He understands that temporary underperformance often says more about market psychology than business reality. By refusing to judge results too quickly, Buffett avoids emotional overcorrections. He stays aligned with the economics of the businesses he owns rather than the opinions of the crowd. When you step back and view investing through this lens, the entire philosophy begins to feel less complex and more coherent. When you step back and look at Warren Buffett's philosophy as a whole, it becomes clear that it is not a stock strategy at all. It is a behavioral system. Success comes from patience instead of urgency, clarity instead of complexity, and restraint instead of constant action. Each principle works because it reinforces the others over long periods of time. Buffett's approach reminds us that wealth is rarely built through excitement or speed. It grows quietly, shaped by a few well-reasoned decisions made carefully and repeated consistently. Long-term investing is not about predicting what will happen next. It is about positioning yourself to benefit from what tends to happen over time. This is the mindset that guides everything we explore on Wealth Surge. When you learn to think clearly, wait confidently, and act selectively, investing becomes less stressful and more durable. And in that calm discipline, lasting wealth has the space to grow.